Hey everybody, this is Lawrence from FinancialThing.com, coming to today from beautifully warm and sunny San Diego, California, here in the United States of America. Behind me you can see the USS Midway, which is a retired US naval battleship and aircraft carrier. Beautiful scenery behind me. If you ever get a chance to come here, highly recommend it. It's an amazing part of the world. When I was on my recent trip to London, I was able to sit down with Uma from Capitalrise. We did a Q&A session. Capitalrise is a peer-to-peer lending company that does loans in very high-end London developments that are usually out of reach of retail investors like you and I. And Capitalrise gives investors access to those types of development through loans, and you can check them out on the website. This Q&A was from reader-submitted questions from people like you, and I threw in some questions of my own in there that I was curious about Capitalrise, as it has been on my radar for a little while. I'm doing some more research. Hope you enjoy the video. If you have any questions or comments, leave them down below, and please like the video, subscribe to the channel, and tell your friends and family about the video because it helps me out immensely. And until next time, have a very prosperous week, and I'll see you soon. Hope you enjoy. So Uma, thank you for joining us. Very much appreciated. Tell me when Capitalrise was first launched.
So we launched the business in 2016, so 3 years ago.
3 years ago. For people that don't know what it is that you're doing, can you let them know what sort of investing products that Capitalrise offers?
So we're a prime property crowdfunding platform. We provide senior and mezzanine loans out to property developers. We have a very specific part of the property market we focus on, which is prime institutional grade real estate. So if you have a look at the website, you'll see previous deals that we've done are in sort of areas like kind of Eaton Square, Grosvenor Square, a lot of prime central London, prime London and home counties.
And what type of areas in London would that be, if to somebody that doesn't know London that well?
Yeah, so I mean PCL, prime central London, is typically kind of, we do Mayfair, Belgravia, Knightsbridge, Kensington, those sorts of areas. You'll see previous deals we've done in kind of Wimbledon. We're screening stuff in Hampstead. Essentially the kind of more affluent areas of London, and the home counties is where we focus.
And what sort of deal sizes are these loans?
So our minimum loan size is $1 million. I think the largest one we've put on the platform is around 8, but we've got deals in pipeline for 15 mil plus.
And what is the minimum investment amount for a lender to go into one of these deals?
The minimum investment is £1,000.
There's obviously quite a few companies that are doing asset-backed property lending. What separates Capitalrise from your competitors, and what gap is it that you're filling?
So I think the very clear kind of differentiator between our platform and all the other platforms out there is the calibre of real estate that we focus on. I'm yet to see a single platform have a single deal that is even similar to the sort of thing that we do. The locations, the asset quality that we focus on is a different part of the market, I think, relative to the other platforms that are out there. That enables us to offer some really attractive risk-adjusted returns. Prime market is a very resilient part of the market. Happy to share lots of details about that and research that we've done that can really show that prime central London in particular is the most resilient part. After every downturn that's happened in the last 50 years, it bounces back significantly faster than London overall or the UK market overall. So it's a very attractive part of the market to be lending to.
And for lenders that come and invest through your platform, is there a way for them to exit out if they need to for some reason?
So we have a secondary market. Obviously, with secondary market, it's reliant on somebody else wanting to buy your particular investment off you, and there's no guarantee that that's going to happen, although it does, and it always has done to date. We do have a very liquid secondary market where if you did want to exit early, you could. Okay, and is that market a fee-based market, or is it is? Okay. Yeah, so we do have a fee of 1.5% for you if you decide to use that.
I read too on the website that the founders invest their own money, and is that in each loan? And can you explain how that works? Is that a set amount, a percentage?
Yeah.
How do you work that out?
Sure. So as the founders, myself, Alex Mitchell and Andrew Dunn, the other two co-founders of the business, we all put our own personal money into every single deal that we put on the platform. have always done that, will always do that. We think it's a really important action that we do to show our investors that we trust the quality of our underwriting and that we would never put a deal on the platform that we wouldn't be happy to put our own personal money in ourselves, and that's our own money, not company money. And we do it on exactly the same terms as everyone else on the platform, just like everyone else. I think it also makes a really important difference in terms of when you're screening the opportunities. So the three of us are all on credit committee, and so when we're approving loans to be funded, we're doing that with the knowledge that we would happily put our own money into that deal. And I think psychologically that's very, very important.
And is that a certain percentage that you put in, or does it vary depending on the deal? How does that work?
Yeah, it isn't, and it's difficult for us to commit to a certain percentage because obviously as we grow as a business and the size of loans we do, I would love to be in a position where I could continue to grow and scale and put millions and thousands in the business, but unfortunately my personal finances don't stretch that. But we do put a significant business amount in. At the early days of the platform, we were putting almost 4 or 5% of from ourselves into those loans, but obviously as a business of scale it's less feasible. But minimum investments are thousands, and we're always putting in thousands into each loan.
Okay, and what type of return rates can lenders expect to receive?
So our forecast returns are between 8 and 12% per annum, with the 8 to 10% being more the kind of senior loans that we do, and the 10 to 12 being more the mezzanine loans, so second charge loans that we do. The average return that has been repaid out to investors on all our loans that have redeemed is just over 10% per annum. So those are our kind of rates of return.
And obviously defaults are a major concern within property peer-to-peer lending. Have you had to recover any defaulted loans as of yet on your platform? How has that process been for you?
So we've had no losses, no defaults to date. All of our investments have redeemed on time or early. In fact, just yesterday we had an early redemption of one of our loans in Belgravia. We're very conservative about our lending approach. Our average LTV at exit is 63% across the book. So that puts us in quite a conservative position. And we actively manage all of our loans. So once the loan has been made, we are very, very active in the management of that project to make sure that it reaches do everything we can to make sure it reaches a successful conclusion on time and we get repaid in full. And
if it runs into a situation where a default happens, is there experience on the team for handling that type of situation?
Yeah, absolutely. So within the team that we've got, we have that skill set, but also what's quite unique about us is two of the co-founders of the business are property developers themselves in exactly the sector that we focus in. So we have a sister company where, should we need that expertise to know how to go in and solve whatever issues are needed to complete a project, we have that expertise that we can use should we need to, which is very different to a traditional bank lender. If a project gets unstuck halfway through a development, what can you do? Whereas we're very uniquely positioned in having that in-house expertise. We would be very easy for us to kind of use that skill set to help solve those issues.
So Uma, obviously we've had this Lendy situation that's happened, and a lot of people are concerned. The trust levels are sometimes struggling right now with peer-to-peer property back. What are your views on that closure and how it's affected the industry?
Well, I think it's very unfortunate. I think this is an industry that's very young. I feel very bad for those investors that have suffered as a result of this. It's not great for the industry. It's not great for the kind of professional players in the industry and the people that are doing really good quality lending. Almost to have the sector tarnished by some platforms that have not done their best by investors. So yeah, unfortunately, it's not great. But I think it makes things like Brismo very important. So, for example, we've just recently integrated with Brismo, who you'll know is kind of independent data analytics provider, who will come in, and we've opened our books to them so they can come and independently verify all of our loan metrics and stats. And I think things like that are very important to kind of regain trust from investors, for people to know that lenders are very happy to open up their books and be interrogated and have their data on display publicly for people to have a look at, because if you're a good lender, you'll have nothing to hide.
The question that I get asked, Uma, mostly now from people looking to get into peer-to-peer lending is, how do they know how to pick a good platform from a bad one? What would be one tip that you could give people who are new to this, who are looking for the good ones?
I would say a few things. Firstly, start with a team. make sure you know who's behind this and that they have strong property expertise. There are too many platforms that are not built by, they don't have that strong property expertise behind them, and that's really critical. Who are the people that are underwriting and selecting these loans? Do they really know what they're doing? What is their track record? That's really essential. I think also you need to look at the sort of the process that they use. In particular, are they getting independent third-party valuations done on these properties that you're lending against? Who are these valuers? I mean, for example, we use Struts and Savills and Knight Frank and all of the kind of the best-in-class valuers to value our properties, and I think that should give people a lot of confidence that their underlying security has been valued by a very reputable a firm that will give them a bit more comfort around the lending that they're doing.
Okay. I think one of the most misunderstood parts of peer-to-peer lending is the risk that lenders are actually taking. A lot of the times they just really don't know what the risk of the investments are. What are some of the steps that you take to reduce the risk for the lenders on your loans that you offer?
I mean, it's a very broad question. I mean, I think you start off by making sure that you're lending to really good developers that have a strong track record, that you can evidence have done projects like this many, many times before. So you can feel confident that they know what they're doing and they're able to, create that value out of that property. We do a lot of thorough DD on their business plan. We do a lot of stress testing on it, particularly the financials. So we will stress test that particular loan and look at what happens if it runs over. What happens if they don't achieve that sales value, if they achieve 5, 10, 15% less? What happens if their construction costs are under budget and they end up overspending by 5, 10, 15%? And we'll model that really carefully to make sure that even if those things did occur, we're still in a relatively safe position and not in a capital loss situation. We look very closely at the actual asset. What's the level of demand for that type of asset? Obviously, we work in a particular part of the market where there's quite high demand. A lot of the assets we're lending to are kind of pretty iconic locations. Grosvenor Square, Eaton Square. There is only one Grosvenor Square, Eaton Square, and so really understanding kind of how. What the appeal is for if the exit is sales for those properties. You look at comps. What are similar properties like that getting in those areas? The independent third-party valuation is absolutely essential. You shouldn't trust the platform. You need to have independent third-party verification of those values that essentially is going to be used for the LTVs. And I think those are probably some of the key things that you need to look at. In terms of development finance in particular, it's very important that as the lender that you are in control over how you feed money into that project, and make sure that you're feeding it through in tranches so that you have control over the borrower. So if, for example, there is an overspend, and that means you don't feed any more money into that project until that's cleared by the borrower. And similarly, that you're only ever lending against, funds where you only injecting funds into a project that have genuinely been spent and the work has genuinely been done, because you have an independent project monitor who is following that project and verifying that that's true.
Okay. One other question that popped into my mind was about tranches. I know you said to me that you tend to have a good fill on the loans that you offer. What were to happen if you were to offer, say, a second or a third tranche of a loan and it had trouble filling? Is there a way you access extra funds to be able to make sure those loans are filled?
So our model is quite different to some of the other platforms in that we always pre-fund the loans on day one and then we refinance on the crowd. So we have funding lines that we can use. So we always fund first and then we put it on the crowd later. So even if a single penny wasn't raised on the crowd, which has never happened, that loan would be fine and the borrower would be fine and we'd continue to fund that. We also have institutional funding lines that we use as well, because our loan sizes are much bigger than other platforms with £1 to £20 million loans. That's, we can't rely purely on our crowd base. So we use institutional funding lines as well to help us fund the deals that we need to do.
One of the other things I talk about is spreads, what the borrowers are paying versus what the lenders are being paid. Do you publish that type of information on your site?
So we disclose the range of the spread we take is typically between 0 and 2% on the interest rate. And also if you look at Brismo data, you can see on an individual monthly basis what the borrower rates are and what the investor rates are. So again, you can see that spread.
Okay. So what's the single biggest challenge, Uma, that Capitalrise is facing in 2019?
It's a good question. I think we've been very lucky in that investor growth has been amazing, as well as growing our loan book. I think for me it's about, I guess, continuing to focus on building trust with the investor base and trying to overcome some of the damage that some of these other platforms have caused within the industry, and sort of help try and kind of build that consumer confidence and just be able to showcase that we are different and we do a very high quality of lending and have a great track record as a result.
Last question, Uma. How is Capitalrise positioned to weather any Brexit storms that may occur? That's a big talk right now, Brexit. What's going to happen? How's it going to affect the property market?
Yeah.
What are your views on that?
So I think the thing that gives us comfort is the sort of LTVs we're lending against. So we're lending at on average 63% LTV. That means we've got 37% headroom in terms of values coming down before any of our investors are at risk, which is a very comfortable position, particularly if you look at in prime central London. In particular, that market's already down. So it's already down 20%, it needs to fall another 37% for my investors' funds to be at risk. So it puts us in a position where we feel very comfortable. I mean, the biggest peak trough fall in prime central London ever since they started tracking these things was in the high 20s. So even if there was a significant fall from where we are now, we still have a lot of headroom before investors are as affected.
Thank you, Uma. There you have it. That is Uma, from one of the co-founders of Capitalrise. If you want to check them out, and we'll put a link in the description below. And thank you very much for your time. We appreciate the information.